joining us right now to help wrap up the day and week in equity trading. We've got Nick Sargen. He's the Chief Investment Officer at Fort Washington Investment Advisors, where he oversees nearly $40 billion in assets. Now, along with navigating investment strategy, he's a trained international economist, so a great person to talk to on this Jobs Friday. In a week where we've had, continuing news out of Europe. Nick, good to have you back with us. First of all, let's start with that jobs report. Has that changed in any ways your economic outlook, your outlook for corporate profits, your outlook for stocks here?
Well, I would say the following, Carol. I was still clinging to hope that amid the slowdown, there was no doubt about that. The one bright spot had been for 3 months in a row, we were getting private sector job creation, about 250,000. That was good. So today was the clincher that, whoops, we can't count on that anymore. So then the next question is, there's no doubt there's a slowdown. Mm-hmm. Is it short-lived or is it more ongoing? And most economists, my colleagues say, oh, it's temporary because the Japan supply disruption effect goes away. You're probably going to see a rebound in auto production in July. You're going to get better weather, and oil prices are off. But the reason I'm less convinced of the immediate upturn story is what we've been talking about, that I think that the consumer is nervous. And if the consumer can't bank on jobs, there's uncertainty. I don't see what it is that provokes the quick turnaround of the economy.
One thing I want to ask you about is the trade we saw today, because I'm kind of surprised that we didn't see even more significant losses. I know we expected pretty ugly numbers here. Let me just bring in somebody, Tobias Lefkovich. He's the chief U.S. equity strategist over at Citi. He told us earlier today about the lack of panic in the markets. Listen up, everybody.
Expectations have gotten ahead of things. We're starting to see expectations back off. And in fact, we're not seeing panic in markets, which is kind of interesting.
I mean, Nick, do you find it kind of interesting that we didn't see a lot of panic selling today? Yes, we were down about 144 on the Dow at its lows today, but we didn't see everybody running for the exits here.
And that's exactly right. Nor do I believe there should be panic. Carol, again, the way I tell the story of the last 2 years is very subpar economic recovery, super strong corporate profit rebound. We have a V-shaped corporate profit rebound. So I think you asked the right question, which is, but can that disconnect? How long can that go on? I just did an analysis of the outlook for corporate profits. And my take is that, yes, eventually, if the economy slowed down, I would expect some moderation in corporate profit growth. But companies have figured out a way to make money in this sluggish environment. And I think, therefore, the proof will be in the pudding in the July results. And that's why I would tell people on the stock market, the rising market is behind us. We're going to be choppy, sideways. But I think profits coming out in July will dictate the next turn in this market.
Well, we're going to be watching the profits for financials very closely. I think people are nervous about the profit outlook for that. And Adam, we know that financials have certainly been a laggard here in this market.
Oh, they've been the worst performing group in the market. Right. And as a matter of fact, if you look at the chart, take a look at this. You've got the S&P. You've also got financials, and the chart speaks for itself. Look at that. The worst performing group year-to-date down about 4.7% versus the market, which is, kind of hanging in there around up 5%. Nick, I know that at one point you had been positive, the financials. You went to neutral.
Yep.
The question is, in an environment where GDP is, where there isn't job growth, where GDP is shrinking, you don't have earnings, do you actually short the financials?
Right. We won't do that. Adam, on that score, that was more of a bottom-up view. We're long-term value investors, and we thought we saw some cheap stocks. But as a sector call, I'm with you that financials that have had the most V-shaped of all profit turnarounds, but the prospects for the industry as a whole, especially with the regulation, aren't that good. So the two areas that I would focus on is, one, the overseas profits of U.S. corporations are off the charts, and they're benefiting from the weak dollar versus the euro. Plus, U.S. companies have gone to cheaper tax havens. And then the other sector is the domestic non-financials, where that's been pretty much a cost-cutting story.
So wait, so Nick, you're staying away from financials or not?
No, what I'm basically saying is in our own portfolios, we're maintaining our positions, Carol, but those are in names that we just think have been beaten up, where we, that's an individual stock pick call. As far as the sector is concerned, I would agree with the general premise that I'm not overly excited about the sector. We just think we found some cheap stocks within that sector.
But you are excited about healthcare. You're overweight there. And Sheila, I want to bring you in because that's been, the best performing group?
Absolutely. So if you've been in the healthcare trade, you've actually done quite well. In fact, it is the best performer year to date so far. So beating out everything else, even energy, which is interesting considering the rise in energy prices we've seen. Having said that, there has been a lot of questioning about this defensive stance that investors have been taking. So Brian Belsky, he actually thinks that this is really a momentum play and that a lot of people are renting out the momentum when it comes to these defensives. Binky Chadha at Deutsche Bank, he points out that defensives right now are looking pretty expensive. And if you take a look at the cyclicals, they're actually looking pretty cheap. So Nick, my question to you is, the healthcare trade has worked for a while right now. It's worked for the year, but is it going to continue to work? Or are things getting too expensive there?
Again, we're value-based investors, and the names that we have in our portfolio we're quite comfortable with holding. And I do think that sector, while it's done well this year, it's been a laggard sector in the rampant run in the prior 2 years. So I'd hang on to that. I think that the other thing, though, Carol, too, that I'd add, just in terms of sector calls, we had a meeting with my portfolio managers today, and a lot of them are scratching their heads because it's just been such a whippy market. And so when I see these things, and we're not quite sure where the dust settles, then what I try to say is let's go for the names we like rather than the big sector calls.
Got it. Nick, going to leave it there. You take care and have a great weekend. Nick Sargen, everybody. Coming up next.